Hi class, this video is going to run through exercise 15.3 of our textbook, which is all about how we complete our journal entries, either in our general journal and general ledger, for recording depreciation and specifically straight line depreciation. It asks us to do pretty much all the skills you're going to be asked to do for straight line depreciation, so it's a great question. I always encourage you to do it along with me, and you'll be able to find the question in your textbook on page 303 and your workbook on page 268. So what is happening in this question? Footscray, if we look at our question on our top left, Footscray Fireplaces have purchased a new delivery van and they've purchased on the 1st of June. Dates, very important in depreciation questions, so remember that. They've purchased it for $19,000. And also delivery charges and stamp duty totaling $2,000 are also paid, along with registration and insurance for $900, which is 12 months cover. We know the estimated useful life of this business is 4 years, and we have a residual value of $6,600. These are the key bits of information that we need to analyse and think about when we're doing this question. Part A is really the calculation section. We're asked to calculate the annual depreciation expense to be written off using straight line method. So let's think about what our depreciation formula is. Depreciation for straight line depreciation, so depreciation expense equals cost minus residual value over or divided by its life. So if we think through our cost here, even though we bought it for $19,000, we need to think, are there any other costs to get this asset into the condition and location to generate revenue? And the dealer charges and stamp duty is definitely that. We need to pay this before we can use the vehicle to generate revenue. So we need to add the $2,000 on. We need to subtract the residual value of $6,600 and then divide it by 4 because there are 4 years, useful years in this business. And that, if we do our calculation, means that we have $3,600 per annual depreciation expense. So that is the expense to be written off. What are some things to consider? Because we've done that relatively quickly. We don't include the registration and insurance. Why? Because it is a recurring cost. And we know it's recurring because it says it is for 12 months cover. 12 months cover means we're going to have to do it again. It is recurring. It is using our terminology, period cost. So we have $3,600 of annual depreciation expense. And for this one, it is also important to work out how much is that per month. So if we divide that by 12, we realize what we actually have is $300 of depreciation expense per month. That is A completed. Let's now move on to B. We need to prepare the journal entries to record the depreciation expense on the balance days of 30 June 2023 and 30 June 2024. So let's do that. I'm not going to do the narration apart from one because it'll be similar, but let's think through what our debits and credits are going to be and also our accounts. The accounts is the easy bit. It's not going to change for either. What are we going to be doing here? If we think through Paler, we are creating an expense called depreciation, and we are also reducing our asset to account for the fact that our van is going to be worth less really due to every year. So what are our details going to be? In our accounts on 30 June, we are going to have depreciation of van, because it is a delivery. You could also do a delivery van. And then you're also going to have your credit of a accumulated depreciation of delivery van, And we're going to do this also for the 30 June 2024 because it's the same entry, but the number will be something that we'll have to consider. So depreciation of van on the 30 June 2024 and accumulated depreciation. Now it's a little bit messy because we don't have heaps of space in that question, but that's important to understand. Let's really think this through. Depreciation of van is going to be an expense that increases, and accumulated depreciation of van is really a negative asset. Really, it's an asset that is going down. So that's the important bit to understand. That's why it's the debit and credit. An expense going up is always a debit, thinking of Paler. Accumulated depreciation is something that will decrease our assets, and that is always a credit. The hard bit here is to recognize that we didn't buy this van on the very first day of the reporting period. We bought it on 1st of June 2023, and we're asked to do our first entry on the 30th of June 2023. So how many months have gone since we bought it? That is a relatively easy question. We have 1 month. If we have 1 month of time since we bought it and our reporting period, we clearly have not had a full year's of depreciation. We've only had 1 month. We've gone to the hard work down the bottom to realize that 1 month of depreciation is $300. So our first period recording on the 30th of June is not 3,600. We're recognizing that our van has only been used up for 1 month, so it is only depreciated by $300. On the 30th of June 2024, however, we have had a full year's worth of depreciation. From 30 June 2023 to 30 June 2004 has been 12 months, so our van has gone down in value, has been used up. The cost is $3,600. You are required to do a narration for both of these. I would always use the template adjusting entry for, and then you would use that time period. So 2023 would be adjusting entry for 1 month's depreciation, and always tell me the method, straight line depreciation, and straight line method, apologies. And on 2024, I would do something along this lines. I would say adjusting entry for, in this case, 1 year's depreciation. And we would then say it is straight line method. And that's important to know because we could be doing reducing balance. And in some ways, we probably should be doing reducing balance because it's a van and it's going to be less efficient, but you just follow the rules of the question. We don't have a memo here, and that's okay. We probably should, and it would in an exam question. That is B. That's actually probably the hard bit. We now have to think through C. And we're asked to prepare the closing entries for depreciation. When you say closing entries, I'm hoping that you are going to recognize immediately closing entries are where we determine profit. And what do we look for when we're determining profit? We look for our expenses. So we have to close our 2 expenses. And we do this as normal using our general journal. What do? We have 2 expenses that are debits. How do we close these expense accounts, get them back to zero? If they're a debit balance, we of course have to credit that. Where does the other side of that go? It goes to our scorecard for determining profit, P&L summary. So actually a relatively easy question. It's just about identifying what they're asking us to do. On 30th of June, we are going to use P&L summary. And we are going to use this to close our depreciation of van. How much did I have to close? What was my expense for 30 June 2023? It was just $300. Now, if I think this through, again, it is asking for a narration. This is a really simple one. just closing entry will suffice. Same deal with 30th of June. It is still the same expense. So we're going to use the same format, P&L summary, depreciation of van. But in this case, it is not $300 that we classified as the expense. It will be $3,600. And we again use a narration of closing entry. And I'm hoping you'll be able to follow that. I know it's pretty messy on the screen, relatively small amount of working space for this one. Key bit there, we have now closed our expenses. We have made them zero in a way because our debits equal our credits. We're ready to start again. And this has been transferred to our P&L summary along with all of our revenue and expenses to complete our determination of profit. Just as an aside, we all know that depreciation of van, this expense, goes in our income statement and it goes in the other expenses, along with all those other expenses that you will see. We have now done all the journal entries, and now we need to think about how we're going to post them. Again, we are going to follow the rules that we have done in our general journal. We are going to find, we have to do this for depreciation of delivery van, and accumulated depreciation of delivery van, but we have done all the work already. Let's just find what we need to do. So if we work this through, we have two debits. If I do a little asterisk, two debits for depreciation of van. We have $300, and I'll do this here, $300 as a debit, and we know that our cross-reference is the other side, accumulated depreciation. And I might just abbreviate this here just to save some room. Accumulated depreciation of van, and we also have our $3,600 on the 30th of June, also accumulated depreciation of van. We have ticked off our debits that have been required to be recorded that we recorded in Part B. What we haven't done is also recorded our parts in Part C, because you can see that we have the same credits for $300 each, because we are, remembering, closing this expense account. It is an expense account and we need to make it zero each time. So we also have $300, $3,600 on the credit side, and our cross-reference here is P&L summary, because remembering we are transferring this to our P&L summary to determine our profit. We have successfully recorded all the debits and credits for our depreciation of delivery van expense account, recording the depreciation and recording the closing entry. Accumulated depreciation is arguably a little bit more complicated. We need to pick up the $300 that we recorded as a credit on 30 June 2023, and our $3,600 we recorded 30 June 2024. So let's do that. They are credits, which mean right-hand side, $300 and $3,600. I'm definitely going to run out of room here. So I'm going to make it really, I'm going to do some abbreviations that we shouldn't do. Depreciation of van and depreciation of van. We've ticked these off. Why is our cross-reference depreciation of van? Because we are doing our cross-reference. We are referencing which is the other side of the transaction. We need to post these, and we recognize that this is essentially an asset account, and that means what are we doing? We have to balance it. We add these up, add up both sides, and we realize that this is $3,900 on our right-hand side, nothing on our left, so we put the highest of both, which means our balance of accumulated depreciation, there's been nice here, they've given our balance entries. This is recognizing that our accumulated depreciation at the end or the start of the next period, 1st July 2024, is $3,900. We now need to prepare the extract of the balance sheet to show how we'd report this van Firstly, 2023, and secondly, in 2024. We're going to have the same heading, and remember there are some rules to follow. We are always going to keep the historical cost of our delivery van in our balance sheet. This can be verified, unlike depreciation. Remember, there is a conflict between making this faithfully represented but also verifiable. We can verify the delivery van historical costs. We can't verify the accumulated depreciation. So we show both less accumulated depreciation. Again, I've shortened that and you won't because I'm running out of space. We had $300 of accumulated depreciation by the end of 2023. And by 2024, we've had an extra $3,600 of depreciation because we've had an extra 12 months. That means at the end of 2023, we have an asset that we are estimating carrying value is $20,700 and $17,100 by the end of 2024. And guys, that is a complicated question. I hope you've been able to follow it. I'm sure it's quite hard to follow on the screen just because there's a lot of detail going on. But that is essentially all the requirements that you're going to be asked to do with straight-line depreciation. We've recognized how to record it. We've recognized how to do closing entries, how to include this in both ledgers and report in the balance sheet. And we've also discussed how to report the income statement. Importantly, we've also recognized how to do this when partial periods occur, which is a very common. I'd be shocked in an exam if we don't have a partial period to calculate as well. Well done for understanding this, following on to the end. So the complicated question, relatively complicated topic, now's the time to keep practicing. Well done.